Thanks, Marty. Thanks for hosting us. It's a pleasure to speak with an esteemed group of family offices here. My name is Young Cho. I'm the CEO, Co-CIO of Blockhouse Digital, and I'm going to discuss about what we're seeing, the opportunities in the digital asset space. Okay, just a little bit about myself. I'm previously from the traditional finance space. I've been in places like Citigroup and UBS for about 12 years, mainly on the credit trading side. So I've seen different cycles in the market. So I've been involved in the Asia financial crisis, post-financial crisis, cleaning up the assets from there, and then also post the Lehman crisis in 2009, 2010. Bought a lot of assets from there when I was at UBS. I got involved in Bitcoin about 2017. And the first time I heard about it, I just hated the idea. I thought, Bitcoin, how is this even money? It just made no sense to me. And then I thought about it for a couple of weeks, and it really makes you go back to first principles. Think about what is money. Money is essentially just whatever people agree upon is money, and it's hard to replicate. So I went back to my friends at another family office called Dominion Capital, and we decided to set up a new lender, and it was called alt lending. And so that was my first foray into crypto. That was about 7 years ago. And since then, I've been in multiple projects, one called Hedera, another one called Abra. Abra was also in the lending space in crypto. And also Hedera. I left Abra right around 2021, and I left there because I was concerned about all the different overextension of risk-taking in crypto credit markets. And so I decided to leave there and join Hedera as their CFO. It was kind of, if you were to say, I was hiding out in the markets to see how badly it would get. I thought there was going to be a blow up at some point. And the blow up happened, and it happened spectacularly. A lot more faster, a lot more bigger than I thought. And I'll talk about that a little more in a bit. But when I saw that and I was at Hedera, Hedera is a layer one protocol, kind of like an Ethereum competitor. I thought this would be a good time to set up a new lender in crypto. And that's what Blockhouse Digital is. So can you see that? Yeah, there you go. So I'll just go over what's happening right now in the crypto markets. Against that backdrop, where's the best place to invest in the crypto markets, crypto credit markets, and how to invest in those markets with us at Blockhouse. So again, probably a little hard to see this, but maybe the folks at home can see a little better. Basically, we've been through, in traditional finance, some fairly large credit blowups. And going all the way back to 1990s, the S&L crisis was one of the most recent ones, the ones that I can remember, but I wasn't really a part of that back then. I was in college. But that recovery took about 7 years from the blow up to the actual time that the RTC was closed. The RTC closed in the late 1994s. So that whole process took about 7 years. This is the S&P 500, by the way, in the blue. But these red windows is like how long it took for the credit markets to recover from those blowups. So that was probably one of the most bigger ones. But the next one was the Asia financial crisis that happened in 1997. And that one, I was at Salomon Brothers at the time. And that one, I did participate as an investor. Basically, all the large companies in Asia were borrowing dollars, and they're earning revenue in local currency. So what happened when their FX currency blew out? Their currency devalued by order of magnitude about 4 to 5x. So their dollar loans, their debt burden went up about 4 or 5x. And so a lot of them went bankrupt. And these are large companies like oil refineries, coking coal companies. These are heavy industry companies. And a lot of my work that I did back then, especially in the oil refinery sector, namely Thai Oil, TPI. These are Incheon Oil. These are large refinery companies in Thailand and Korea. I see a lot of similarities of what happened back then with what's happening in crypto now. Is and kind of I know it might sound like a far-fetched analogy, but there's a lot of similarities. We'll talk about that in a bit in a moment. So that period took about 7 years to recover too. That's the IBRA, which is the Indonesian Bank Restructuring Agency. That company, that agency folded or shut their doors back in 2004, 2005. So it's a 7-year period. And then obviously the largest one that we've seen in recent years is the Lehman crisis. That happened obviously in 2009. And it took about six or 7 years for that for the credit markets to recover there too. And that the window there I measured was when the Fed stopped their quantitative easing, QE3. That was roughly around 2014, 2015. So we see large cycles for credit to recover, even though equity markets come back a lot quicker, right, than the credit markets. Credit markets just generally inherently take a little bit longer, a lot longer. And so now that takes us to the credit blowups in crypto. This is probably arguably the largest blow up in crypto history because there's just a lot more volume, a lot more participants in this past blow up than in the past. And so this is Bitcoin. This is on a log chart. And then you could see the trigger for this credit blow up. It was really, it was a lot of leverage taking through futures and also through credit. But the credit was one of the biggest fuels to blow up, create this bubble. And that resulted, when the first thing that happened was Terra Luna collapsed. That was one of these stable coins that a lot of people were putting their money into, earning 20% yield on sustainable yields. And when that collapsed, it triggered all these other lenders like Genesis, BlockFi, Voyager, Celsius to go bankrupt. And that all happened in the span of less than a year. It was a lot faster and a lot quicker than I thought. And they had some pretty large balance sheets. You know, at the peak, they had probably over 50 billion in loans outstanding. Yeah.
What was the percent of the total marketplace from these failures? Like, was it 80%, 70%, 95%? Like,
in terms of the capital that was
being lent.
Yeah. So here, let's go in there.
I don't want to get ahead.
Yeah. Okay. So this is the loan book for the largest lenders as of June 2022. This was kind of right when things were just about blowing up. Bitcoin was down a bit. The loan book for these large companies was actually larger at the peak. It was probably closer to around 50 billion that I was mentioning. But this is right around June when Bitcoin came back down, and then these companies started going into bankruptcy. So it was around 13 billion. So yeah, this, like I mentioned, it was triggered by Terra Luna. That was a large stablecoin pool operator. They were paying unsustainable rates. There are large hedge funds like Three Arrows. They're actually borrowing unsecured with no financials. This is the type of risk taking that was happening in crypto, and that resulted in when one lender, one counterparty went down, they all went down because they're all lending to each other. It's cascading effect, and you could see that that happened pretty quickly. And right now, that Bitcoin was around 15,000 at the low in this recent cycle. Right when all these companies like Genesis were going bankrupt. But Bitcoin has recovered a lot, all-time high, 72,000. But the credit market has not. The credit market is always, as I've seen in the past, takes a lot longer to recover. So that's where we see the opportunities. We'll see the opportunities as if you're lending or setting up a bank back in 2009, 2010, post the Lehman crisis, when no banks had any risk appetite. And if you were to set up a fresh new lender with a clean balance sheet back in 2010, you would have virtually no competition. You'd do pretty well. And so this is where we see the opportunity in lending to the crypto markets. How do we lend? Well, let me just go over this chart real quick. The crypto market is kind of skewed. There's more participants willing to finance the equity capital markets and tokens than debt. So if you look at back in 2021, back in the heyday, there was dozens of companies, venture capital firms that were willing to provide financing for equity or tokens in crypto. And also in the credit space, there's several dozen lenders as well. But if you look at today, the crypto equity capital markets and venture world is still pretty crowded. There's still no shortage of VC financiers. But if you look at the debt side of it, there's virtually none. Yeah.
A16Z raised a $9 billion crypto fund?
Yes, that's recently. Yeah, $9 billion.
Right.
Yeah.
Before
Yeah.
Crash, right?
Okay.
So when you talk about special situations, what does that mean in terms of crypto?
I'll get into that. Yeah, about how to invest. Yeah. So there's hybrid loans where we can do kind of like what I did in the past when I was at Citi. We would get basically some upside participation through equity warrants, and yeah, collateralized. Yeah, warrants, options, collateralization of different types of assets. They're just not straight plain vanilla loans. So going back, yeah, there's just virtually no debt providers out there in this market. And if you look at any normal, healthy, functioning economy or functioning industry, there's always a healthy equity capital markets and a healthy debt capital markets. In crypto, there's really no lenders anymore.
So what does debt in the crypto space entail? Is that I'm borrowing Bitcoin or I'm borrowing dollars?
Both. Yeah. So
you have cases of.
Yeah, I'll get into that. You have very good questions, Marty. Okay. So where to invest? How to invest? Okay. The first place we see a lot of opportunities is in Bitcoin miners. So that chart there kind of shows you different cycles of Bitcoin mining. So you could see that when hash rates increases and prices increase, everybody piles in. They try to buy more equipment. When prices go back down, they're trying to recoup. They're trying to monetize that, and hash rates still kept coming in. And then when hash rates go down and prices go down, there's usually a shakeout. So there's this lagging effect. What happens with the Bitcoin miners? The profitability is driven by the price of Bitcoin, by the difficulty rate of Bitcoin mining, and then also their electricity costs. And not all of that is perfectly synced and correlated to the price of Bitcoin. People say, well, okay, price of Bitcoin's going up. Well, why isn't the Bitcoin mining companies that are public listed, how come their stock price is still in the gutter? Okay. How come they can't, why is the price of these ASIC machines that they basically use for mining Bitcoin, why are they still so cheap? There's a lag effect. It takes time to place the orders. It takes time to make those ASICs. It takes time to make delivery. It takes time to find a hosting facility. So because of the specifics about Bitcoin mining itself, the business, it's not perfectly correlated to just the price of Bitcoin. There's a lot of other factors. And because of that, there's a pretty interesting opportunity now to lend to Bitcoin miners. Because a lot of these large Bitcoin miners, a few of them went bankrupt as well. They've overextended themselves, a similar way that I was talking about how I've seen in the oil refining business. What happens when in any heavy industry where there's a lot of capital expenditures requirements, when they see the price of oil go from 20 to 100 to 120, they start buying more facilities. They start buying more equipment because they think the price of oil is going to keep going up. They think it's going to go to 200. So with that, it takes a while for them to get delivery on those CapEx expenditures, the capital equipment. And because they all assume that the price of oil continue to go up, they continue to buy more and more capacity, expanding too aggressively. They over leverage themselves. The price of oil went back down to $10 in a matter of a couple of years, and they all went bankrupt. And that's what I saw out in Asia. And so we're seeing we saw some similar something similar happen in the past couple of years in Bitcoin mining. And that's where we see opportunities today. In the aftermath of that over leverage and overextension of capacity, now these Bitcoin miners are actually not taking delivery on these ASICs. And so what happens is these large ASIC manufacturers like Bitmain, Bitdeer, they have all these canceled orders and they're trying to dump them into the market. So just to give an example, S19 is kind of like the standard Bitcoin mining machine out there. That used to trade for about $12,000 for one computer. One computer was $12,000. It was about almost $1,000 per terahash second. Now they trade for about $2,000. Okay, so it went from 12,000 to 2,000. It's almost like an 80% drop in ASIC prices. And there's still a flood of these ASICs out there in the market. So the miners that are healthy, that still want to grow, they want to take advantage of buying those cheap ASICs, but they don't have access to capital. Why do they not have access to capital? Because the traditional lenders like Genesis, BlockFi, Voyager are all gone. And so where do they go for capital? Well, they have two choices. They can sell equity. These Bitcoin miners can sell, some of them are public listed, and they can sell equity at pretty low valuations, very expensive capital. Or what they're doing now, they rather not do that. What they're doing now is going to very non-traditional ways of borrowing. Some project finance lenders, some small family offices, but they can't get the capital. They can't get the large pools of capital that they need. So some of these project finance lenders, they don't know and understand how to lend against Bitcoin. They say, okay, well, here, I'll give you the perfect form of collateral, Mr. Project Finance Lender. Here's Bitcoin. They can't take it. They don't want to take it. They don't know how to custody it. They don't know how to deal with it. They're just used to hard assets, real estate. So these Bitcoin miners are in a tough spot, and they're trying to take advantage of cheap basic prices and also grow their business because they need to get ready for the halving. The halving's happening next month, in a month and a half. That's when the profitability gets cut in half, or not the profit, but their revenue gets cut in half. And they're trying to increase their capacity to increase their economies of scale. They have to. Otherwise, some of these guys will die.
Does Bitcoin usually decline in price after a halving?
That's an interesting question. I have a chart about that, but that's not covered here. But usually it actually goes up. If you look at, that's in the past 3 halvings. Okay, it's not to say that's going to happen this time around. So what happens in the prior 3 halvings, Bitcoin's gone up anywhere from like 2.5 to 4x. 400, I looked at the window, 480 days before the halving. It goes up about 2.5 to 4x. Before the halving, okay. After the halving, it goes up anywhere from 7 to 30x. If you want to look at I don't really put too much weight on the first 2 halvings because not that many people were buying Bitcoin back then. So it's hard to look at that historical fact pattern and apply that to the future. The prior halving, the one that happened 4 years ago, Bitcoin went up about 2.4x, 480 days before, and then afterwards went up about 4.5x. So it did go up more. And back then, there was about 50 million Bitcoin holders. Today, there's over 300 million.
Oh, really?
Yes.
Doesn't that saturate the market?
Yes, that's my point. So what happened in the prior halving may not necessarily be repeated in this halving.
So
okay.
Since Marty's kindness having in Texas is the biggest load for Bitcoin that's being pushed out by ERCOT. So
are they being pushed out by ERCOT? Are they?
Yeah.
Okay. I'm not sure about that. I think Bitcoin.
I'm sure about that. I said on the committee.
Okay. They're actually being put, all the Bitcoin miners in Texas?
They're being a lot more selective.
Okay, they're being more selective for sure, but not the existing ones are not being pushed out.
Yeah.
Okay.
Those opportunities they just can't get gear to get power.
Okay. Yeah. Okay. Interesting. Yeah, I need to talk to you afterwards.
Hanging out on Bitcoin mining stages like for the last 4 months and listen to them all day long.
Yeah.
All of it.
Yeah.
All the economic fundamentals that there's actually one Bitcoin miner that actually I think they're going to be moving into some debt.
They're going to be moving into borrowing more, or yes, yeah. Yeah. I mean, we're seeing a lot of different inquiries about borrowing from Bitcoin miners. It's.
Well, this is different.
Yeah.
Debt instrument.
This is a different type of debt instrument. Okay, we can talk about that more in detail.
Are the loans that you'll be making at the same rates as in the past? Are they steps?
So for this particular type of borrower, we can charge mid-teens, 15, 16% cash yield. And then we can, if they're a relatively medium-sized company, some actually, one of the companies we're talking to is publicly listed. We can get equity warrants as well for about 20% coverage.
Are they typically collateralized?
100%, yeah. So more than 100%. I mean, definitely collateralized. So if they're providing Bitcoin as collateral, we'll get 1.4x collateral, meaning if I lend them $1 million, they'll give us $1.4 million of Bitcoin. If they don't have enough Bitcoin, because sometimes these miners, at least the smarter ones, they sell their Bitcoin to fund their operating expenses. A lot of them actually hold it because they think the price is going to continue to go up. But the ones, some miners don't have enough Bitcoin to pledge as collateral. And so in that instance, we'll look at their actual warehouses, their data centers, the structure, the land, the heavy electrical equipment. There's a lot of transformers. Those things are pretty expensive. They're anywhere from several hundred thousands of dollars for electrical transformers. And so for those types of equipments, it's not just specific to Bitcoin mining. You can use that data center for cloud computing. It's not just Bitcoin mining. So that's where the retrofit there is going to be. And that type of collateral will take 2x collateral, the market value.
And what's the capacity for your strategy?
So, I was just looking at this a few days ago. If you look at all of Bitcoin mining itself, just globally, right now it's about 600 exahash. Right, 600 exahash. So if you assume that all machines are the same S19s, just to make it simpler, the math, S19s are about 100 terahash per second. So that means there's about 6 million ASICs in the world mining Bitcoin, 6 million computers, assuming they're all S19s. Each one of these S19s trade for $2,000 per machine. So what is that, like $12 billion? That's the market value for all Bitcoin mining machines in the world. And that's just the ASICs. With the ASICs, these computers, you need the warehouse to put them in. You need the electrical equipment to transform the power from AC to DC. And you need also the cooling equipment, the warehouse, the land, all of that. So that's somewhere in the order of magnitudes of $20 billion total, my estimate. That's the global capacity. We're not saying that we can go rent every single one of these, but that's how big the total addressable market is. I was just looking at this a few days ago as well.
Do you have an idea on what percent of these are actually credit worthy, though? I mean,
yeah, because
what you're selling is your risk management.
Yeah, that's right.
The other dozen that just collapsed for bad business practices.
Yeah, well, so a lot of those guys, they actually went into Bitcoin mining business itself instead of lending to it. They actually decided to take the equity side instead of the debt side of that trade, and that's probably they over leveraged, they overextended themselves, without having any protection on the debt side, on the collateral side. So that market, I mean, if I was looking at the listed companies, public listed companies, the largest public listed companies in Bitcoin mining, and they have total currently about only $400 million of debt. But the market cap of these 20 largest companies is close to about 10 billion. So the debt to equity ratio is pretty low. It's around 5%. That's compared to other normal heavy capex intensive businesses. Their debt to equity ratios are closer to 1.1x, and in Bitcoin mining it's 0.05. It's a very lopsided market in terms of the debt and equity mix between Bitcoin mining. So where else can we lend into? The opportunities, we're seeing a lot of OTC trading firms that are asking for demand for capital. They're interested in borrowing Bitcoin, Ethereum, and stable coins, and they need liquidity for two reasons. They're looking to fulfill trade orders with their customers, and also they're looking to provide leverage to their customers as well. So just kind of an example, if you're a large Bitcoin holder and you go to an OTC trading firm, you don't really want to deal with the exchanges because you have let's say you have $50 million of Bitcoin you want to sell. And so with that, you don't really want to deal with the exchanges. There's a lot of slippage. You just want a certainty of execution, and that's when you deal with the OTC traders. And so if you put in an order to sell $50 million of Bitcoin, you say at the end of 2 weeks, tell me what my price is, tell me I got filled, and then we'll settle. Well, these OTC traders, they don't have $50 million of Bitcoin on their balance sheet. And most of these clients won't pre-fund. They won't give the 50 million of Bitcoin before you start executing the trade. So these OTC traders need that Bitcoin to borrow to go and start executing those trades over that 1 to 2 week period. And that's where they need capital. And so this, in the past, what we used to do is if you were lending to these OTC traders, you would transfer the Bitcoin. They would take it off of your custody, go onto the exchange, and it would stay on the exchange as they're fulfilling those orders. If one thing that came out of the FTX blow up that was good out of all that was that there's this new technology where in the custody world that you don't actually have to keep your coins on the exchange to enter the order. What they do is, if there's a solution called Clearloop in Copper, it's a new custodian. It's been around for several years, but they have this new technology called Clearloop. If you can keep your Bitcoin at your custodial account, and once you execute trades with the exchange will settle your trade at the custodian level. You don't have to move your coins to the exchange. You don't have to wait for it to actually get traded and then move it back off to the custody. It stays in the custodial account. And then the exchange, they'll say at the end of the day, okay, you sold 50 Bitcoin, here's your dollars. They'll move it in and out at your custody account. So that takes away a lot of the counterparty risk that a lot of people dealt with the exchanges. That's what happened. People kept their assets at FTX because they had all these orders they were running, and then FTX blew up while their assets were sitting on their exchange. None of that anymore. Keep it out of your custody account. Settlements happen in your custody account. You never have to move it to the exchange.
So who's the custodian for what you're doing?
Well, we're using several. We're going to use Fireblocks. We're going to use Zodia. So those, they have similar technologies. They have similar off-exchange settlements technology.
So none of the well-known non-crypto custodians are in this space, or?
Well, yeah, well-known non-crypto, like the,
your custodians that work with hedge funds and.
Oh, those are prime brokers, right? Yeah, banks don't touch crypto. Morgan Stanley won't bank us. Chase will never bank us.
What about independent prime brokers or things like that? Yeah.
Well, most of the large ones are attached to investment banks. They won't.
Yep.
Yeah, they won't touch us. Yeah, it's to their detriment. But so with these types of.
But these loans are not insured.
These are not insured. No, but there's no FDIC insurance behind this for sure. So with these types of settlements, we can lend to OTC traders in a pooled fund, in a pooled account, where we have BTC that we lend to them. We require them to put additional BTC in there, so they have essentially like an equity piece, and then that pool of assets is over collateralized, and we're lending to them. We have the keys, and the custodians have the keys. We have access to that collateral anytime that we need to. So that's another way we can lend to these OTC traders over collateralized. A third way is through settlements funding. There's a lot of on-ramp and off-ramp platforms. Essentially, there's a lot of wallets or companies where their users want to buy Bitcoin. They have a credit card on file. They can, usually what they do is they buy like maybe $100 a week or something like that through their credit card. And when these platforms, they allow them to buy Bitcoin, they have the Bitcoin immediately, but they don't get the cash from these credit card companies until 3 to 5 business days later. That's just how long it takes to settle with WorldPay, FIS, a lot of these credit card service providers. So what happens? These on and off ramps, these wallets, have a funding gap of about 3 to 5 business days. And so this is one area where we're seeing a lot of inquiry where we can finance short term their customers' purchase of digital assets. This is just another chart that kind of goes through the summary of all the different ways we can lend into the market. But again, there's what's unique about this is that no traditional banks will touch these types of lending, these types of loans. They will most of these loans are collateralized, and there's no native crypto lenders to really compete with us in this market anymore. So this is what Blockhouse Digital is going to specialize in primarily. We are a new lender in the space. We have the experience, we've both in traditional finance and in crypto, and we're going to do all the lending into the market with risk management and regulatory compliance top of mind. So how we're setting up is we're setting up as a proprietary lender and also a fund manager. The fund is going to be in US dollars. That vehicle will be mainly for lending to the Bitcoin miners, mainly the illiquid type investments. And then the proprietary lender will be lending out Bitcoin, Ethereum, and stable coins. Okay. And those will be more liquid. Those will be more liquid type loans that we originate and give back. And so we're also looking into being CFTC regulated. That's a lot what's happened in the past. If these other wallets like Abra, Celsius, BlockFi, those companies were led by tech entrepreneurs. Those tech entrepreneurs have never really managed risk, have never really managed a loan portfolio. Most of them they're serial entrepreneurials, had other tech startups. And so what does tech startups do? They get as much AUM, as much users on their platform, as more users that get on their platform, the higher the valuation goes up. And then they sell their company and then they move on to their next tech startup. And so that's kind of the reason why a lot of these other wallets have blown up in the past, is because quite frankly, they just never managed risk. Our team has we grew up in managing risk. I started at Solomon Brothers, their quantitative research team. Again, I moved over to, when we got purchased by Citigroup, I moved into the distress and special situations investment group, was there for total 10 years, UBS for a couple of years. So my whole MO has been about risk management. Anthony Merriman, our Co-CIO, he also came from traditional finance. He managed the several billion-dollar portfolio at AQR Capital, and he was our volatility trader there. And he also worked at Morgan Stanley Investment Management. So we understand risk management, and we really truly appreciate being regulatory compliant, because we're not trying to go move and live in Bermuda or Bahamas or anything like that. We both live in Texas. We're staying here, unlike other crypto companies. And look, the rules are not always entirely clear, but when you have to choose whether it's a commodity, security, we choose one, and we stick to those regulations in those rails. And so that's a far cry from what the other wallets and lenders have done in the past. So That's extremely important to us. And so what do we do? Again, we're lending into these major different opportunities that we saw, the three different types of opportunities we're seeing in Bitcoin mining, lending into that market, lending into OTC traders, and then also lending into the short-term settlements funding. So I gave a little description about who we are. So myself, I think you've heard Anthony again. He also comes from traditional finance and worked in crypto as well for several years. Most recently with Talos, is a technology trading company that's being used by some of the largest institutional traders in crypto. And Randy Song, he's our Chief Business Development Officer. He worked with me when we were at Abra together, but he also comes from traditional finance. He was at JP Morgan and Oaktree for several years, and then later on moved to Abra and worked with me for a couple years there. And this is us in a nutshell. Again, probably covered most of this as well, but here you can see our backgrounds. So yeah, that's the end of our presentation. I can take questions if there's any in the audience.
I don't know if I missed it, but did you go over what kind of returns you're targeting?
Yeah, so on the dollar fund, we're targeting about 10% in yield, and that's again, most of the loans will be over collateralized with Bitcoin at about 1.4x, and with real estate and hard assets about 2x, and potentially there we could get some equity warrants, like I mentioned, on these companies. And so one of the first deals that I did in crypto was we lent $20 million to Bitfarms. Bitfarms is now NASDAQ listed. Back then it was listed in Tel Aviv Stock Exchange. And we increased the capacity to a point where their valuations back then when we went to them, they were only about maybe $40 million in market cap. Most recently, at the height of the market, their valuation went up to $2 billion. I think now they're sitting at around like $400 or $500 million in equity valuation. So, you know, if you make a material enough loan to some of these companies where it drastically increases their profitability and likelihood of surviving, those equity warrants could be pretty valuable. And in that particular deal, where we lent $20 million to them, the family office that I was with at the time, they sold those equity warrants for $80 million, 80. So they almost 4x their investment.
I have a question about, this is like a bunch of questions, but maybe you can like pack it in. So one, what percent of mining is happening in Texas relative to the rest of the globe? So it's like a lot, like 80%, or it's a ton. And then the other question is, you know, I noticed like the publicly traded Bitcoin miners, you know, they're starting to diversify their business lines, right? Because they need to do that. That's smart. And some of it can be data centers, but there's also the big power play, right? The efficiency on power. And so, you know, I saw some of them doing like, you know, renewables in Argentina. And I don't know if that's just greenwashing or if it's just, you know,
I think it's greenwashing.
Yeah. That's what I thought.
Yeah.
And then the other thing is, so you think some of that diversification, renewable stuff is greenwashing. And then as far as business lines, I mean, my thought is, okay, they're doing other things besides just, you know, getting from the grid, getting power. They're doing all sorts of, you know, off-grid applications, oil and gas fuels, yada, yada. But, I mean, do you see other types of businesses besides the data center, the energy play, global diversification for whatever reason? I mean, what else is the...
So, yeah, I mean, so you asked about Texas particularly. And so I don't know exactly what percentage. It is a lot. And my opinion is it's probably only going to be for a medium-term period. It's not going to be indefinite. And I'll tell you why. It's because most of the newer miners in Texas are trying to take advantage of the stranded nat gas fields. And those fields only last for about 5 to 7 years. And so they're not here for good, okay? The guy from ERCOT probably would be relieved to hear that, okay? But basically what they do is for everyone's context, there's a lot of stranded oil and nat gas fields, a lot of oil fields in Texas are stranded. there's not enough P1 or P2 reserves there for them to build the infrastructure to capture the nat gas and then transport it on the pipeline. So what they do is they just flare it. They flare that nat gas to get access to the oil. And so in doing so, what they're doing is they're harming the environment. They're creating a lot of methane with that. And then second, they're just, they're not able to monetize on that. So what these Bitcoin miners have done, they said, okay, well, we will set up right next to your oil well. We'll capture that gas. We'll put a transformer on site and convert it to electricity in the nat gas. And they will, these Bitcoin mining equipment, you can put them in containers, like those 20-foot car containers that you see on those boats. You can put them in there with all the air cooling and water cooling immersion technology inside, and they can park it right next to the oil field. And then they use Starlink for internet. And so that type of, they're getting that gas virtually for free. I just, one guy out in Odessa, he said that he just charged his Bitcoin miner $1,000 a year. He doesn't care because he doesn't want to be burning it. He doesn't want, there's a lot of talk in Washington about penalizing these guys for burning that gas out there. So that's what's been happening in Texas, West Texas, and a lot of miners came here because of that. It's economical for them to do that because they're getting electricity at almost like 2.5 cents per kilowatt hour. And that's, the grid charges 12.
We've got time for one more question.
Yeah, sure.
Any more questions? Jen, last question.
So also they're taking like, one group took a decommissioned wind farm and built it back and used that. So they took an asset that was out of play, and then that helped with community development. So there's a lot of real innovation happening. That they're also moving to the edge of other basins besides the Permian, because there's also going to be, there's a lot of methane emissions regulation going down. And all these oil and gas firms have to play with that, especially as they merge and all that. But yes, you're right. I mean, that play is just happening.
It's just started past year or so, and it's going to continue. I think once these stranded oil fields get depleted, a lot of these kind of mobile Bitcoin mining operations will probably move out. Yeah.
So why? So here, my last question is this: so why are guys like Bart and Brad Stevens and Dan Moorhead and Mike Novogratz all investing in you when they see the opportunity, or?
So Pantera, they do liquid tokens. They do VC.
Talking about Pantera,
they do.
About Dan
Moorhead. And personally,
yeah,
would love an intro.
Okay, got it.
Okay. I talked to the Pantera guys about setting up a credit arm under their umbrella. They just didn't return my phone call. I sent them an email.
Would you be willing to do a stable credit arm?
Absolutely. Yeah.
You should send me like a 2-paragraph note, and I'll forward it to Dan directly, who I know for many years. Okay. And I'll send it to Bart Stevens too.
Okay. Love
He's
that.
angry at me when I skip the secretary, but
Yeah. Okay. No, appreciate it. Thanks, Bart.
No, I'm just saying, if it's viable, why not go to the guys who are the kings, right? So.
No, I agree.
Queens.
I agree.
I'm good at white paper writing.
I just need 2 paragraphs.
I'm talking about white paper.
Oh, white papers. Yeah. You got a new project in crypto, sounds like.
I'm a white paper queen.
Okay.
There you go.
All right.
Fantastic. Listen, great job. Thank you so much.
Thank you.